You probably picture the world's greatest traders sitting in front of 6 monitors, watching charts move by the second. Maybe they're looking for the perfect entry. Maybe they're predicting the next crash. Maybe they simply have an instinct for money that ordinary people could never develop. But when you look closely at the people who actually built extraordinary fortunes through trading, something doesn't quite fit that image. Some of them barely looked like traders at all. One was a mathematician who had never worked on Wall Street. Another became famous for betting against the British pound. Another built a career around understanding market psychology and economic cycles. And some of the most successful did something even stranger. They stopped trying to predict the market. So what separates these people from the millions of traders who enter the market every year, convinced that the next trade will finally change their lives? Is it intelligence, information, risk-taking, or is there a completely different skill hiding underneath all of it? To answer that, we have to start with one of the strangest trading stories in modern financial history. His name was Jim Simons, and before he became one of the most successful traders in history, he was solving mathematical problems for a living. Simons earned his doctorate in mathematics and worked as a mathematician and codebreaker during the Cold War. Finance was not the obvious next step, but in the late 1970s, he began experimenting with financial markets. The important part wasn't that he discovered some magical stock-picking formula. It was the opposite. He started questioning the entire way people thought about trading. Traditional investors often tried to understand businesses. They studied management teams, industries, economic cycles, and financial statements. Simons approached the market differently. He wanted to know whether enormous amounts of historical data contained patterns that could be detected mathematically, and if those patterns existed, perhaps a machine could find them faster and more consistently than a human. That idea eventually became Renaissance Technologies. In 1988, Renaissance launched the Medallion Fund. What happened next is difficult to exaggerate. From 1988 through 2018, Medallion reportedly generated an average annual return of about 66% before fees, or roughly 39% after fees. Over that period, it produced more than $100 billion in trading profits. Those numbers matter because compounding turns a large percentage into something almost absurd. But the real story isn't the percentage, it's how they got there. Simons didn't build Medallion around a superstar trader making brilliant decisions. He built a system. Mathematicians, physicists, computer scientists, cryptographers, and other specialists worked together to identify statistical relationships in financial data. The objective wasn't to know where the market would be next Tuesday. It was to find small, repeatable advantages. A signal might be weak on its own, but thousands of signals, combined with disciplined execution and risk controls, could potentially create something much more powerful. And this changed the definition of what a trader could be. You didn't necessarily need to be the person who could look at a chart and say, "I know what's coming." You could instead build a machine that didn't care what you believed was coming. That distinction is crucial. Because markets punish certainty. A trader can be right about the economy and still lose money. They can correctly predict a recession and enter the trade too early. They can identify a great company and buy its stock at the wrong price. They can even make the correct prediction and lose because the market moves differently than expected before eventually proving them right. The world's best traders understood this problem in different ways. And that's where another name enters the story: George Soros. Unlike Simons, Soros became famous for discretionary trading. He wasn't trying to remove human judgment from the process. He was trying to understand how markets behave when millions of people are making decisions based on incomplete information. In 1992, that philosophy produced one of the most famous trades in financial history. Britain was part of the European exchange rate mechanism, which attempted to keep the pound within a defined range against other European currencies. But economic pressure was building. The British government was struggling to maintain the pound's position. Soros and his team believed the arrangement could not hold, so they made an enormous bet against the currency. On September 16, 1992, Britain was forced to withdraw the pound from the exchange rate mechanism. The day became known as Black Wednesday. Soros's Quantum Fund reportedly made around $1 billion from the trade. That single event helped turn him into a financial legend. But here's the part that is easy to misunderstand. The trade wasn't simply a case of Soros knowing the pound would collapse. The deeper skill was recognizing an imbalance. The British government was trying to defend a currency level that economic conditions were making increasingly difficult to sustain. Soros wasn't just betting on a number, he was betting that the system itself was under pressure. And that's a recurring theme among extraordinary traders. They don't necessarily know the future. They identify situations where the odds appear unusually asymmetric. Sometimes the edge comes from mathematics. Sometimes it comes from understanding human behavior. Sometimes it comes from recognizing that a financial system is being held together by assumptions that are beginning to break. And sometimes the greatest advantage is knowing when not to trade. Because there is another uncomfortable truth about successful trading. The market doesn't pay you for being active. It pays you for being right when the opportunity is worth the risk. That sounds obvious. In practice, it's incredibly difficult. Every price movement creates a temptation. A stock rises, and you feel like you're missing out. A stock falls, and you feel like you should buy the dip. The market goes sideways, and you start searching for a reason to enter. The professional trader has to fight that instinct, and some of the greatest traders built entire careers around waiting for situations where the potential reward justified the risk. That brings us to another legendary figure, Paul Tudor Jones. In 1987, Jones was watching something that most investors were not prepared for. The stock market was rising rapidly. But beneath the surface, he saw signs that the structure of the market was becoming unstable. On October 19, 1987, the Dow Jones Industrial Average collapsed by roughly 22.6% in a single day. It remains the largest one-day percentage decline in the Dow's history. Jones reportedly made an enormous profit by positioning his fund for the crash. But again, the lesson isn't simply predict crashes, because that would be the wrong conclusion. Crashes are extremely difficult to predict consistently. The more interesting lesson is that Jones had spent years studying market behavior, price patterns, risk, and momentum. He wasn't waiting for a prophecy. He was building a framework that told him when conditions were becoming dangerous. And when the evidence changed, he was willing to change with it. That sounds less exciting than having a crystal ball, but it is far more useful, because the greatest traders weren't necessarily the people who made the most accurate predictions. They were often the people who were best at responding to uncertainty. And that distinction becomes even more important when we look at how these traders handled losses, because every one of them was wrong, repeatedly. The difference was what happened when they were wrong. For a normal trader, a losing position can become emotional. The brain starts negotiating. Maybe it will come back. Maybe I should hold a little longer. Maybe I can add more here and lower my average price. Suddenly, a small mistake becomes a much larger one. The legendary traders had another option. They could accept that the original idea was wrong. And that might be the most important trait of all. Not predicting the future, not having perfect information, but being willing to abandon a beautiful theory the moment reality proves it wrong. Because in trading, survival comes before brilliance. And the people who understood that best were about to turn risk management into something far more powerful than simply avoiding losses. Consider what happened to Jim Simons, but there was another detail that mattered enormously. Medallion was not allowed to grow indefinitely. Renaissance eventually chose to limit how much capital Medallion could manage, and the fund was largely kept for employees and insiders. The reason was practical. A strategy can have an edge and still stop working when too much money is pushed through it. Imagine finding a narrow doorway that leads to a room filled with money. If 10 people know about it, they can move through easily. If 10 million people try to squeeze through at once, the doorway becomes the problem. Trading strategies can work the same way. The more capital a high-frequency or high-turnover strategy controls, the harder it can become to enter and exit positions without affecting prices. So one of the world's most successful trading operations did something that sounds completely backward. It limited its own size. That tells us something important. More money does not always create more opportunity. Sometimes it destroys the advantage that created the money in the first place. And that idea separates legendary trading from the fantasy version of trading sold to ordinary investors. The fantasy says the goal is to find a strategy that can make unlimited money. The reality is that every strategy has constraints: liquidity, timing, transaction costs, competition, position size, human psychology, and eventually other traders discovering the same idea. This is why the greatest traders rarely relied on one giant prediction. They built systems around probabilities. Ray Dalio took this idea in a different direction. Instead of concentrating everything around one market or one economic scenario, Dalio built Bridgewater Associates around understanding how economies behave as interconnected systems. Bridgewater became closely associated with an approach known as risk parity, which focuses on balancing risk contributions rather than simply dividing capital equally. A portfolio can look diversified while still being dominated by one underlying source of risk. You might own stocks, bonds, commodities, and other assets. But if one economic environment causes several of them to fall together, the apparent diversification doesn't help much. The broader idea is simple. Successful traders think about what can go wrong before they think about how much they can make. That sounds conservative. It isn't. In highly leveraged markets, controlling downside can actually create the freedom to take larger calculated bets when the opportunity is unusually attractive. And this brings us to one of the most misunderstood ideas in trading: risk. Most people think a great trader is someone who takes enormous risks and gets rewarded. But the opposite is often closer to the truth. The greatest traders take risks that are large relative to their normal behavior only when they believe the potential payoff justifies them. Then they cut the position when the evidence changes. The size of the bet matters, but the relationship between risk and reward matters more. Soros's famous pound trade illustrates this principle. Being wrong is normal. What matters is how much you lose when you're wrong and how much you make when you're right. That philosophy sounds simple until real money is involved, because losing $10,000 doesn't feel like losing $10,000 on a spreadsheet. It feels personal. Your brain starts looking for excuses. And this is where psychology becomes part of the trading system. Fear can make you exit a winning position too early. Greed can make you stay too long. Ego can make you defend a bad prediction. And after a loss, the desire to recover can become even more dangerous. A trader loses $5,000. Instead of accepting it, they increase the next position. Now they aren't trading the market, they're trading against their own emotions. The professionals know this problem exists, so they build rules designed to reduce the number of decisions their emotions can influence. Jim Simons used algorithms. Paul Tudor Jones used strict risk controls. Soros built positions around macroeconomic imbalances. Dalio built portfolios around different economic environments, different methods, different personalities, different markets. But underneath them is a similar principle. The goal is not to eliminate uncertainty. The goal is to survive it long enough for your advantage to matter. And then there is another trader who demonstrates just how different successful trading can look: Stanley Druckenmiller. Unlike Simons, he wasn't famous for an entirely automated system. Unlike a traditional stock picker, he often focused heavily on the direction of major economic trends. And unlike traders who spread hundreds of small bets across markets, Druckenmiller became known for concentrating capital when he believed the opportunity was exceptional. His record at Duquesne Capital became one of the most respected in the industry. But perhaps the most revealing example came during the European currency crisis. Druckenmiller worked alongside George Soros during the famous pound trade. The position was enormous because the opportunity was enormous. But that is the important distinction. Concentration without conviction is gambling. Concentration combined with deep research, a clear thesis, and a willingness to exit when the thesis breaks is something different. This is one reason copying successful traders almost never works. People see the position. They don't see the reasoning. They see the profit. They don't see the years of experience behind the decision. They see the trade. They don't see the dozens of trades that were rejected before it. And most importantly, they don't know the risk the original trader was willing to accept. That is why a screenshot of a winning trade tells you almost nothing. It is the equivalent of watching the final 5 minutes of a chess game and assuming you understand the strategy. You don't. You need to know what happened before the move, what alternatives were considered, what information was available, and what would have caused the player to change direction. The same is true in markets. And perhaps the most uncomfortable lesson comes from comparing these legendary traders with ordinary investors. A typical person might spend hours searching for the next stock that could double. The greatest traders often spend just as much effort thinking about what would make them wrong. That sounds like a small difference. It isn't. It changes the entire game. Because if you focus only on finding winners, every opportunity looks attractive. If you focus on controlling losses, most opportunities suddenly look mediocre, and that creates selectivity. You stop asking, "How much can I make?" You start asking, what would have to be true for this trade to work? Then, what would prove me wrong? Then, if I'm wrong, how much will I lose? And finally, is the potential reward worth taking that risk? Those questions are much less exciting than predicting the next market crash, but they are much closer to how professional risk-taking actually works. Still, there is one final question. If these traders were so successful, why can't everyone simply copy their methods? Why don't their strategies destroy the market? Why doesn't every hedge fund use the same formulas? And why do even brilliant traders eventually struggle? The answer reveals the final piece of the puzzle. Because the market is not a machine waiting to be solved once. It is a competition. Every advantage attracts competitors. Every profitable pattern gets studied. Every successful strategy eventually changes the behavior of the people trying to exploit it. And when enough traders discover the same opportunity, the opportunity itself can disappear. That means the greatest traders were never simply finding permanent secrets. They were constantly adapting. And eventually, that becomes the real test. What happens when your advantage starts disappearing? The market is not a puzzle you solve once. It is an opponent that changes as soon as you start winning. That is why the careers of the world's most successful traders are so revealing. They did not discover one perfect strategy and spend the rest of their lives repeating it. They adapted. None of their methods depended on being right all the time. Their advantage came from what happened after they were wrong. They all lost. They all changed their minds. And they all operated under the same uncomfortable reality. There is no such thing as certainty in a market. Even the most sophisticated models are dealing with probabilities. That is why one of the biggest differences between professional traders and amateurs isn't the ability to predict. It is the ability to respond. Imagine two traders looking at the exact same stock. The first says, "This stock is going up." The second says, "I think this stock is going up. But here's what would make me change my mind." The second trader sounds less confident, but that uncertainty is actually a strength. Because the market doesn't care how confident you are. It only cares about what happens next. And that brings us back to the question we started with. What actually makes someone one of the world's most successful traders? It isn't simply intelligence. If intelligence were enough, every brilliant mathematician would be rich. It isn't courage. There are plenty of people willing to risk everything. It isn't access to information. Modern markets give almost everyone access to an extraordinary amount of information. And it isn't even the ability to make accurate predictions. The deeper advantage is the ability to combine an edge, disciplined risk management, and emotional control over a long enough period for compounding to take over. That last part is easy to underestimate. A 10% return doesn't sound extraordinary, but repeat it year after year without suffering catastrophic losses, and the mathematics become powerful. This is why avoiding ruin matters so much. If you lose 50% of your capital, you don't need a 50% gain to recover. You need a 100% gain. Lose 75%, and you need 300% just to get back to where you started. A major loss doesn't simply hurt today's account balance. It changes the mathematics of everything that comes afterward. The great traders understood this. Their first job was not to become rich. It was to remain in the game. Because if you're still playing, opportunities keep appearing. If you're wiped out, the next opportunity is irrelevant. This is also why the popular image of the fearless trader is misleading. The best traders aren't fearless. They understand fear. They understand greed. They understand what happens to the human brain when money is moving rapidly. And instead of pretending those emotions don't exist, they design systems around them. That may mean algorithms. It may mean position limits. It may mean diversification. It may mean stop-loss rules. It may mean holding cash, or sometimes it means doing absolutely nothing. That last one is particularly difficult, because financial markets create the illusion that you should always be doing something. Prices move every second. News arrives constantly. Analysts publish predictions. Social media creates new narratives every few minutes. The pressure to act is enormous. But activity is not the same thing as progress. A trader who makes 20 trades a day isn't necessarily more skilled than someone who makes 5 trades a year. In some cases, the opposite is true. The important question isn't how often you trade, it is whether you have a reason to trade. And this is where the stories of Simons, Soros, Jones, Druckenmiller, and Dalio converge. Their methods were radically different, their personalities were different, their markets were different. But they all treated trading as a process rather than a series of guesses. They searched for an advantage, they measured it, they tested it, they controlled the downside. and when the evidence changed, they adapted. That is a very different mindset from the one promoted by the modern trading fantasy. The fantasy says there is always another winning stock, another secret indicator, another guru, another strategy, another trade that can make you rich quickly. The history of successful traders tells a much less exciting story. There is no permanent formula. There is no guaranteed setup. There is no strategy that works forever. There is only a temporary advantage, surrounded by uncertainty, competition, and risk. And the moment you understand that, trading starts to look less like gambling and more like decision-making under uncertainty. That distinction matters far beyond financial markets. A business owner makes a bet when opening a new location. An investor makes a bet when buying a company. A manufacturer bets on future demand. A technology company bets millions of dollars on a product that may fail. Even ordinary people make financial bets constantly. The difference is whether they recognize them as bets. The world's greatest traders simply became exceptionally good at understanding the structure of those bets. They knew what they stood to gain. They knew what they could lose. They knew what evidence would change their minds. And they understood that being wrong was not the real danger. Staying wrong was. That may be the most important lesson hidden inside the careers of these legendary traders. You don't need to predict every move. You don't need to win every trade. You don't even need to be right most of the time in every strategy. You need an advantage. You need discipline, and above all, you need a way to survive your mistakes, because the market will eventually prove you wrong. It proved Soros wrong. It proved Jones wrong. It proved Druckenmiller wrong. It challenged Simon's models. It challenged Dalio's assumptions. The difference was that their mistakes did not have to become disasters. They could take the loss, change the position, change the model, wait, and try again. That is what makes their stories more interesting than the profits themselves. The billions are impressive. The percentages are impressive. The famous trades make great headlines, but underneath all of it is something much more ordinary. A repeated process of making decisions with incomplete information, managing risk, learning, adapting, and doing it again. The world often remembers the trader who made the billion-dollar bet. It rarely remembers the hundreds of decisions that made that bet possible. And perhaps that is why the most successful traders are so easy to misunderstand. From the outside, their careers look like extraordinary predictions. From the inside, they look much more like disciplined probability management. The greatest traders weren't fortune tellers. They were risk managers who occasionally found extraordinary opportunities. And that changes the question we should ask when we look at their success. Not, how did they know what was going to happen? But, what did they do when they didn't know? Because none of them knew. And that was never the point. The real advantage was learning how to make money in a world where certainty doesn't exist. And perhaps that is the strangest thing about the world's most successful traders. Their greatest skill was not seeing the future. It was accepting that they couldn't. If you found this breakdown useful, subscribe to the Apex Magnate for more documentaries about the people, strategies, and hidden systems behind money and business. Because the biggest fortunes aren't always built by predicting the future. Sometimes, they're built by understanding risk better than everyone else.